FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 11/21/19. Well, you know, modern existence, our modern conveniences, all of our technology rely upon 3 basic things, and that is energy, mining, and infrastructure. And you take away any of those, what I would call the legs of the 3-legged stool, and you have nothing. And yet it's underappreciated. It is underinvested in, undercapitalized, certainly at this point in the cycle. And we need to understand that better. So tell me your feelings about the extractive industries, about those 3 areas, because you're going to hear from somebody who runs a fund dedicated to value investing in those 3 sectors only. Hard to believe. And the email address, if you haven't got it already, is kl@kerrylutz.com. Well, person you're about to hear from, he's been on Wall Street in the figurative sense, since he was 16 years old. He is a managing partner of Massif, that's Massif Capital, LLC. His name is Will Thomson. And Will, we welcome you to the show. Hey, somewhere along the line, you got kind of hooked on bricks and mortar and the stuff, the real wealth. And yet the rest of the world has kind of drifted away from you, hasn't it?
Thanks, Kerry. I don't know when it happened. I love computers as much as the next guy, but the investing world has certainly drifted away from it. It's definitely not in vogue at the moment, and it's definitely been a tough place to operate for the last couple of years. But as you point out, without the bricks and mortar, without the copper and the silver and whatnot that comes out of the ground, we don't have the modern world that we've got. So fundamentally quite important. And that fundamental importance creates great value that just needs to be tapped.
Yeah. And you consider yourself to be a value fund. So you're doubly on the outside because you're into those mundane things, resources, infrastructure, energy, and they have to be basically, energy and resources. Mining has got to come from the earth. And then you're into the value sector. So you're twice cursed.
Very much so. The portfolio can be a painful one to hold, but it's quite remunerative if held for a long time. I would say that at the moment, value is a great place or a great way of thinking about the world if those are sectors you're interested in, though, as they are all trading at or near not just, sort of cyclical lows, but oftentimes historical lows. And so energy in the United States as a percentage of the major indices is as low as it has ever been. I'd have to go back and look at material stocks, but there is maybe 1 mining, maybe 2 mining firms in the S&P 500. Mining just doesn't play a role in finance whatsoever these days, so it is as cheap as it can get. You still need to find good management teams. You still need to find trustworthy people to sort of invest with, and you still need to find good projects. But the whole group of companies in the industries we look at are historically cheap.
And so this presents a problem, though, because they're cheap, and that means that investment in these sectors is probably not where it needs to be to sustain the economies of the world.
Yes. So we often take what we call a capital cycle approach to sort of making some, we'll say, larger top-down decisions that we occasionally make about where to, say, look for a value company. And the capital cycle that we think about is on the supply side and how much money is being put into finding new gold projects or finding new copper projects, if you're talking about mining. Infrastructure, same thing in the United States. We can look around and see it. How much money is being spent on maintaining our roads, maintaining the water system, for example. And so we often take a capital cycle perspective and find it quite helpful. And right now, at the moment, as you point out, there's not a lot of money going into these industries. And the result is that at some point in the future, and we don't know when, and that's always, sort of one of the challenges one has with value investing is this timing challenge. But at some point, there will be a bottleneck, and the demand will vastly outstrip the supply, and the benefit of being early will accrue to those who have put money in now. I think that one of the challenges with value investing, people often get value investing explained to them, and they sort of get a Warren Buffett or a Charlie Munger sort of like approach, and they sort of walk away thinking, well, I'll buy something cheap and I'll sort of put it away, and it'll quietly compound, causing no pain and no trouble whatsoever for the next 10 years, and I'll wake up and I'll be wealthier than I am today. But the fact of the matter is that a lot of value is value because there are, some fleas on it, or because you sort of have these macro issues that are stacked on top of each other, one on top of the other, and it becomes this spring, if you will, that gets loaded up. And then eventually the spring pops. The potential to make a lot of money is there. And the supply side and the capital being invested in the industries are one of those weights that is sitting on top of the spring for a lot of metals and for a lot of energy infrastructure, a lot of infrastructure in general, and certainly in parts of the sort of industrial sectors overseas, especially less so in the United States. But it's, one of those weights that's weighing things down.
Right. So,
we only have so many apps that we need, but we definitely need a lot more fixed goods at the moment.
I thought we had an insatiable appetite for apps, but look, so define value though, because you mentioned Warren Buffett has his definition. I'm sure Peter Lynch had his, Benjamin Graham had his. What's your definition of a value stock?
Yeah, so I think, we probably take a slightly broader perspective than most people. I'm looking for a dollar that I can buy for 50 cents, and that's usually on a sort of a discounted cash flow analysis basis, which is a bit perhaps of a quantitative value perspective. And there's certainly more that goes into it. As I said, you need a good management team and things of that nature. But right off the start, an asset is, and we're sort of buying physical assets here, is only worth the future cash flows that it'll throw off. And so for us, at least, we start with a discounted cash flow, which has some complication to it. But even though it's difficult, it doesn't mean it isn't the sort of right valuing these assets.
Mm-hmm. Okay, so basically, you're looking to buy companies at a discount to what the price the market currently assigns to them. So much for efficient market theory, because we know that at various times stocks are undervalued and overvalued in the market. And then, of course, you're confining yourself to those three sectors: mining, energy, infrastructure. So of those three sectors, where do you see the biggest value plays today?
Well, so we think that the biggest opportunities for most people at the moment would definitely be found in the mining sectors and the basic materials. And I would highlight a couple of specific metals. So anything related to electricity right now is going to be have a long-term tailwind to it. Now, one has to be careful about some of the battery-related metals because the markets are quite small and quite niche. And so there can be a lot of sort of excitement and tops blow off quite quickly in commodity markets. But things like copper, we think lithium is very interesting, but we don't think now is an appropriate time to invest in it. And there are various reasons for that related to how much supply there is and where the actual bottlenecks in battery creation are. But so anything electricity related. We also like gold quite a bit at the moment. And that has, I would say that has a lot to do with sort of the way the federal government is handling the monetary situation, the levels of debt we see at various companies throughout the world. And also, of course, there is a supply side issue with gold, although it'll take a couple of years to play out. Outside of basic materials, I think we like the idea of being short U.S. industrials and being long industrial companies elsewhere in the world. We like toll road infrastructure where it can be had, mostly in Europe. And that's sort of a broad sweep of where we're looking. Energy is probably the most complex industry for us at the moment. The transition, if you will, that is ongoing to a lower carbon economy is quite complicated to sort of pick winners and losers in at the moment. And, oil is, in some regards, oil companies are historically cheap, and in other regards, they might look expensive. But we tend to think that offshore oil is an interesting place to be looking right now. We don't think that the United States, though, is necessarily a particularly fruitful place for people to be spending their time, just because a lot of the political risks, the environmental risks, and the fact that the business models, the fracking business models, are so very difficult to understand the flows of cash through them. That's a particularly challenging place to look for value.
Mm-hmm. So when you find a company that appears to meet your screen, what kind of due diligence do you do to prove out whether or not this is an appropriate investment for the fund?
Yeah, so I think that with what we call liquid real assets, all these companies are liquid real assets. It's very important. The operations are very important. And so understanding exactly how the management team is going about producing whatever they are producing or mining whatever they are mining is very important. And so for us, the diligence process obviously starts with some of the standard things that everyone else does. We read the financials, the 10Ks, but then usually involves, in the case of, say, mining, a site visit, and that can be, anywhere because there are mines that are everywhere, and sort of meeting with management teams, things of that nature. We think that the sort of high touch nature of that type of research, the on the ground research, provides insight and value that one just can't get sitting in a skyscraper in New York City.
Mm-hmm. So management, and then obviously any analysis, the company is going to be an analysis or involve an examination of management. What are you looking for with management?
FSN Radio. It's all about what's next.
Otis Gold Corp is a gold development and exploration company with quality projects in the pro-mining state of Idaho. Otis's flagship Kilgore project has a resource of 961,000 gold ounces, and its recently published preliminary economic assessment demonstrated an impressive post-tax IRR of 53% at $1,500 gold. In addition to the significant expansion potential at Kilgore, Otis is exploring its highly prospective Oakley project. This Carlin-type gold deposit already has an inferred resource, and previous near-surface drilling intersected 123 meters of 0.69 grams per ton gold. Otis Gold Corp trades in New York under the ticker OGLDF and in Toronto under the ticker OOO. That's triple O. To learn more, go to otisgold.com. That's otisgold.com.
The Financial Survival Network. It's all about what's next.
Well, I think that you start with, especially with natural resources, you start with what their history of execution has been in other projects. Very rarely do you come across a management team in the natural resources industry, for example, mining or oil, who hasn't previously run a mining and oil or a mining company or an oil and natural gas firm. You get people within the large industrial firms, like the large integrated firms like Exxon, that come up through the ranks. And so that's a little more challenging. But at a junior or a mid-level miner or a small exploration company, those guys usually come from somewhere, and they've usually had success either with a previous deposit or getting a previous project up and running. And so I think the first thing we like to see is that history of successful execution. One of the other things we like to see is sort of how they're thinking about capital allocation from a cyclicality perspective. And so you look at someone like Mark Bristow, who's currently the CEO of Barrick Gold, previously ran Rand Gold, which is primarily in Africa. And what you see when you look at him is that when everybody else was selling assets in the gold space to try and make up for the debt that they took on from buying assets, he was himself buying assets and deploying capital. And then when everyone else was buying, he just sat back and collected the cash. So that counter-cyclical deployment of capital is quite important for natural resources industries in particular. So I think those would be sort of two of the big things to look for would be a history and then their sort of capital allocation perspective and specifically it being counter-cyclical.
And then obviously you're not going to stay in this for life. You've got a time frame involved here. What's your time frame?
Our investments usually mature in about 3 to 5 years. There are a few, sort of exceptions. Sometimes it, happens a little quicker. If it takes much longer than 5 years, it's usually something we've made an error on, or it morphs into something more than we had expected. And that doesn't happen very often in the natural resources space. You don't get a lot of, in the Warren Buffett sort of style value investing, you get more compounders. Within the spaces we operate in, you don't see a lot of compounders. And so you sort of have to get in and get out a little more frequently, perhaps, than some other value investing strategies. Although, again, 3 to 5 years we think is a pretty reasonable timeline.
3 to 5 years. And what kind of returns are you projecting out over the 3 to 5 year period?
So our hurdle rate, our investments need to believe that we will generate about a 15% compounded annual sort of return on each investment. And that is so that we can deliver a portfolio that returns about 12% a year net of fees. We think that 12% a year net of fees is something worth paying for in this world. Last couple of years, that certainly has trailed the market a little bit, but we think that over a full cycle, that's something worth paying up for.
Right. So it must be frustrating when you look and you see the Dow, you see the techs, the FANG stocks, although they don't really call them that anymore, reaching new highs almost daily or weekly. And you're kind of left with your conservative portfolio waiting for the rest of the world to catch up with you. I certainly, there are mornings I wake up and I open the Wall Street Journal or Financial Times and I just can't figure out what world I'm in. Does seem to, with the WeWorks and things of the world sort of blowing up a little bit, it does seem to be perhaps shifting, although the shift has been quite slow and, as you suggest, painful over the last couple of years. Yeah, but in the end, you're actually buying interest in companies that have something as opposed to intellectual property, which it's really easy to lose your competitive edge or have it stolen, or someone comes out with a new thing, and then you're kind of left holding the bag. And we see there's loads of companies like that. Are there any tech companies that are in the, say, infrastructure segment that you might be interested in?
I think, there is an interesting trend, and we keep an eye on it. And I mean, this is nothing your listeners probably haven't heard before, but of course there is the trend of this sort of industrial internet, let's say. And one can see how companies in the tech sector can envision businesses where the technology is integrated further into real world operations. And we've looked at the evolution of tech in mining, and we've looked at the evolution of tech in oil and natural gas. And you see fracking, for example, is very much a technology-driven evolution. There absolutely probably are some opportunities. I would say that at the moment, from a technology perspective, the infrastructure side of things is still in the sort of the planning stages. The sort of smart cities, if you will, absolutely will someday be a reality. But at the moment, they are still just ideas on a page. And the companies that will, drive that change, I think are still yet to be, in many cases, yet to be even formed.
So when we look at all the predictions for electric vehicles and all the technology that's going to require, all the technological investment in the grid, homes, et cetera, what's your take on electric vehicles?
Well, so we believe that electric vehicles are, we'll say, the future. The transition is going to take much longer than people expect. And I think you already see that in the way some of the car companies have rolled back some of their projections. I went to buy a new car recently with my wife, and we went to the Volvo dealership, and I looked around, and Volvo couldn't sell me an electric car yet. Mm-hmm. Yet when I went on the internet just to look, because I thought they had said something about it, just a couple of years ago, they had predicted that by next year, I believe it was, they would have a full slate of electric vehicles. And of course, they're not going to come anywhere close. So the transition is taking much longer than people expect. It's definitely a transition that'll happen. I will say that there are a couple of places I think people are making some real errors, though, in judgment. And one of those places is to do with some of the large integrated oil and natural gas firms, and perhaps some of the large utilities that maybe are all in coal now, or haven't really paid much attention to diversifying into renewables. And the mistake people are making is that this transition is going to require engineering know-how on a huge scale, the ability to execute massive projects that require thousands of employees and giant balance sheets. And the reality is that there are only a handful of companies out there that really have that set of capabilities and the balance sheet to back it up that exist. And most of them are in natural resources industries of some kind. Google may have a ton of intellectual firepower, but they have never actually gone out and built anything. And the difference between what occurs on a computer and, say, a 3D CAD program and the actual execution of building some of the renewable power projects that are going to be necessary, or building some of the plants and refineries necessary to process minerals for batteries. These are going to require companies that right now may be focused on oil, natural gas, or other natural resources, because they're the only people that can do it.
Interesting. So don't throw out the old line companies so quickly, because they've got an area of expertise that not only is valuable, but is going to be in much demand in the not too distant future. So if you're looking at this EV future, you got to look at it a little closer, because there's a lot more moving parts than you're thinking about, and a lot more challenges. And, like you said, Will, there's a transition that's going to take time and a lot of capital that many of you aren't focused on at this point. So, Will, really appreciate you coming on. Any questions or comments for Will? Again, email us, kl@kerrylutz.com. Just tell us how we find out more about you on the web, Will.
Yeah, so our fund can be found at massifcapital.com. We provide some sample research reports up there, as well as some of our letters and some white papers we've written on various topics we discussed today. And we're always happy to chat with anyone. We've got some email addresses up there, and feel free to reach out.
All right. Appreciate that. And like I said, you can email us, kl@kerrylutz.com, Twitter feed @kerrylutz, Facebook page, Financial Survival Network, and the site is financialsurvivalnetwork.com. And if you're watching YouTube, listening on any number of podcast platforms, please subscribe, like, and share us. It really helps a lot when you do. And put down some comments there. We get back to you and we'll answer all. Will, it's been a pleasure. Thanks so much for coming on.
Thanks for having me, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.